When most people look at Bitcoin, they ask a really simple question. Is it going to win or is it going to fail? And look, it sounds logical, right? But that's just not how serious investors think. Because markets, they don't operate in a simple yes or no. They operate in probabilities. And when the outcomes are uncertain and the stakes are this high, the smartest people in the room, they don't think in binaries either. They think in odds, they think in scenarios, and they think about position.
And this is exactly why so many of us get stuck with this question. It's the classic trap. We feel like we have to make this huge binary choice. Either you jump in with both feet, you go all in based on pure conviction, or you sit on the sidelines completely waiting for some kind of certainty that, let's be honest, is never going to come. Both of those paths, they usually end up in the exact same place, regret. So in this explainer, we're going to break down how the pros really think about uncertainty. So you can look at an asset like Bitcoin like an intelligent allocator, not just someone reacting to headlines.
Okay, so let's dive right into this all or nothing mistake. This black and white thinking, it feels disciplined, doesn't it? It feels responsible, but it almost always fails during major market transitions, which is exactly where Bitcoin might be right now.
And this slide just lays out the two failure paths perfectly. On one side, you've got the conviction trap. That's the person who's so sure they bet the farm way, way too early. And on the other side, you've got the certainty trap. That's the person who waits for perfect clarity, for all the lights to turn green. But of course, by the time that clarity finally arrives, the real opportunity is long gone.
And this quote, man, this gets right to the heart of the issue. It's not about having a crystal ball. What separates the people who build real wealth in these moments? It isn't perfect prediction. It's their process for dealing with uncertainty. This tells us one thing, loud and clear. We need to change our decision model.
So to find a better model, we actually have to look in a very unexpected place. A place where the cost of being wrong is way, way higher than just losing some money. Yeah, I'm talking about the CIA.
So after a string of massive intelligence failures, the CIA did this deep, painful internal review. And what they found was fascinating. The problem wasn't a lack of data. No way. They were drowning in information. The root cause was the way decisions were being made when things were fuzzy. Analysts would latch on to a single explanation early on and then just filter everything through that one lens. So something had to change, and it was a big one. Instead of asking a binary question like, is this report true or false, which sounds a lot like, is Bitcoin a buy or not, they were forced to ask a much more difficult question. What are all the plausible explanations? This completely shifted the entire process, from just seeking a single answer to analyzing a whole range of competing ideas. This whole approach got a name, the analysis of competing hypotheses. And the goal here is so profound. It's not about being right 100% of the time. The goal is to avoid being certain and wrong, because in intelligence work, that's the real catastrophe. And once you get that distinction, you realize that markets work the exact same way. Okay, so let's take this new CIA-style lens and apply it to the official story that most of us hear about Bitcoin, right? That it's volatile, it's speculative, and we should all just wait for more clarity. That story treats Bitcoin like any other asset. But what if it's not? What if we're actually in the middle of a major transition? Well, if we use this kind of thinking and look at the actual structure of the Bitcoin market, not just the noisy headlines, we can see three specific cracks in that whole wait-and-see narrative. And these are the kinds of cracks that always show up when a market is moving through a massive shift. Okay, so the first crack is realizing that price is not the same thing as the odds. Think about it. Price is a lagging indicator. It's like looking in the rearview mirror. It just tells you where transactions have already happened. The real odds, the forward-looking picture, are revealed by positioning, which is really just a fancy way of asking, who owns this thing now? Who is structurally prevented from owning it? And who might be forced to own it down the road? And that leads us directly to the second crack. You hear people say, oh, the smart money is already in Bitcoin. But when you really look closely, the largest pools of capital in the entire world are still sitting on the sidelines. That's not deep conviction. That's widespread disbelief. And in markets, that kind of disbelief, it's actually a form of misprice. I mean, we're talking about the absolute largest pools of capital on the planet. Pension funds, massive insurance companies, sovereign wealth funds. We are talking about trillions of dollars that, for regulatory or policy reasons, have basically zero exposure today. When that kind of capital finally has to move, it doesn't just trickle in. It often moves all at once, like a tidal wave. And the third crack is just realizing that smart capital never, ever waits for certainty. In every single major market transition in history, The pattern is the same. By the time the regulations are crystal clear and adoption is obvious to your grandma, the best odds are gone. You have to remember, positioning leads capital, not the other way around.
So if the official story has all these cracks in it, what's the alternative? Well, this is where we get to the actual framework. You see, real investors don't try to predict outcomes when the future is this uncertain. They handicap them. And handicapping is just a disciplined way of answering one simple question. Given what I know right now, how should I be positioned? It really breaks down into 4 pretty simple parts. First, do the real work. Build your actual case for or against Bitcoin before you even look at a price chart. Second, think in odds, not just these binary win or lose outcomes. Third, find your edge, and we'll talk about what that means in a second. And finally, and this is probably the most important part, watch the positioning, not the day-to-day noise. And let's be really clear about what an edge is. It's not about being a genius or having some secret information. It's simply where your analysis of the probabilities differs from what the market seems to be pricing in at this very moment. An edge comes from doing the hard work others won't, or thinking in timeframes that others can't. All right, let's put this whole framework into action. This is where the rubber meets the road. We're going to move from theory to practice and focus on the absolute core takeaway. Position yourself based on probabilities. Don't even try to predict the future. The entire mental model shifts with this one simple change. You just stop asking that binary, all or nothing question. Instead, you start asking yourself, okay, what are the plausible outcomes for Bitcoin from here? And how likely do I think each one is? This changes everything. And this is a perfect way to visualize how that works in the real world. For example, let's say you think there's a 50% chance the price of Bitcoin goes lower from here. Well, then it makes absolutely no sense to be 100% in cash, does it? Instead, maybe you allocate 50% now, and you keep the other 50% as dry powder to put to work later if your odds turn out to be right. See? That's not market timing. It's handicapping. It's a rational response to uncertainty. Always remember, the goal is survivable positioning, not perfect timing. It is not about avoiding every single loss or calling the exact bottom. It's about sizing your allocation so that the crazy market volatility doesn't force you into a panic sell at the absolute worst possible moment. The process is the discipline, because at the end of the day, this is what it all boils down to. Markets don't care how smart you are. They don't care how strong your opinion is. They reward structure. They reward people who have a repeatable process for making decisions when nobody knows what the future holds. And that really just leaves us with this final thought. By moving away from that simple in or out framework, you stop just reacting to the world and you start actually operating within it. You start asking a much, much smarter question, one that embraces uncertainty and prepares you for a whole range of futures. So the real question is, how are you positioned?